Welcome to Talk Tickers, your shortcut to being well-informed on the latest earnings calls. Today, we're taking a deep dive into the SLB second quarter 2025 earnings call.
Yeah, and this one's quite interesting.
Definitely. What's fascinating isn't just the raw numbers, but how they seem to reveal this quiet strategic transformation happening, almost like a stealth technology play hiding within traditional oilfield services.
That's a great way to put it. We had Olivia Lash, the CEO, Stefan Vige, CFO, and James Armanddonald, SVP of Investor Relations, on the call from Paris.
Right, and they kicked off with the usual caveats, forward-looking statements, non-GAAP measures, all that standard stuff.
Exactly. But you're absolutely right to highlight that strategic shift, because looking at Q2, it was undeniably solid performance.
Especially given the headwinds, right? Macro environment, market volatility.
Absolutely. Considerable headwinds. So these results, they don't just show survival, they really reflect SLB's broad operating footprint, their tech leadership, and just strong execution, really.
Okay, so let's get straight to the headlines then. What were the core numbers? What's the initial vibe?
Well, okay, so second quarter earnings per share, excluding charges and credits, that landed at 74 cents.
Okay.
That's up 2 cents sequentially. So steady progress. Overall, Q2 revenue hit $8.5 billion. That was up 1% sequentially.
Just 1% overall, but was there anything driving that?
Yeah, and this is, I think, a crucial detail. That growth, modest as it was basically driven by a pretty robust 2% growth in their international markets.
Ah, okay. So holding steady on the top line overall, but seeing that international strength pull it along, did that translate into margins? Especially with those headwinds you mentioned.
It did, yeah. And that's where the efficiency story really kind of shines through. Their pre-tax segment operating margins, they actually climbed 20 basis points sequentially, hit 18.5%.
Nice.
And company-wide, the adjusted EBITDA margin for Q2 came in at 24%. That's a sequential increase of 21 basis points. So, it's not just a minor tweak. It really shows their operational discipline.
Yeah. Getting more out of each dollar, basically.
Exactly. Extracting more value, even when things are challenging. It's one of those early signs, I think, of that pivot towards maybe higher margin, more capital light operations we might talk about.
And what about cash? Did they generate much?
They did. Pretty healthy. $1.1 billion in cash flow from operations. And free cash flow saw a really significant leap, actually.
Oh, yeah.
Yeah, $622 million. That was up $519 million sequentially. Now, a chunk of that was seasonal improvements in working capital, but still strong generation.
That kind of cash certainly signals, good balance sheet strength.
It highlights a real focus on capital efficiency, yeah. And digging a bit deeper into the financials, it's kind of interesting how they handled charges and credits.
How so?
Well, net zero impact on EPS in the end. They had, 9 cents in charges for things like headcount reductions and investment impairment, plus another 2 cents for merger stuff related to ChampEx and OneSubsea.
Okay, so some costs there.
Right, but what's clever is these were completely offset by an 11-cent gain they got from selling their interest in the Palliser APS project up in Canada.
Ah, so smart portfolio moves, balancing things out.
Exactly. Smart portfolio optimization, kind of in action, surgically refining their asset base, as you put it before we started.
Yeah, it seems that way. And speaking of capital, their investments, their CapEx was $520 million in Q2.
Right. That brings their full year expectation down to about $2.4 billion. That reflects the ChampEx acquisition impact, obviously.
And it's interesting, they mentioned they're operating at basically maintenance CapEx levels, right at the low end of their usual 5 to 7% range of revenue. How does that fit this capital light idea?
Precisely. It fits perfectly. And that Palliser asset sale is a prime example. That deal completed near the end of Q2 yielded $316 million in net cash proceeds in the quarter. Plus, there was another $22 million in Q1.
Okay.
And just for context, those Palliser assets, they generated about $215 million in revenue in the first half of the year. And with pretty impressive margins, actually low 50s EBITDA, low 30s pre-tax.
So selling a high margin asset, but still expanding overall margins, that suggests they're really reshaping, not just shitting stuff.
That's exactly it. Reshaping the portfolio for a more efficient future, focusing on where they see the best returns, perhaps in less capital-intensive areas going forward.
Makes sense. Looking ahead then, their free cash flow outlook, they expect it to be materially higher in the second half compared to the first.
Yeah, driven by improved earnings, better customer collections, lower inventories, kind of the usual H2 dynamics, but amplified.
And they're already beating their own target, right? The full cycle free cash flow margin target, over 10% of revenue.
They are, yeah, which is quite something in this environment. So more cash coming in, What does that empower them to do?
Good question.
Well, it gives them immense flexibility, whether that's for more strategic moves like ChampEx, more share buybacks, or future investments in those high growth spots like digital. It really underscores their financial strength.
Okay, let's pivot then. How did the different parts of the business perform? The divisions, any standouts this quarter?
Production Systems really led the pack. Revenue hit $3 billion there, up 3% sequentially. Saw strong sales in things like artificial lift, midstream systems, valves.
And margins?
Margins were up too. Increased 28 basis points to 16.4%. And this is a segment, that's going to be increasingly strategic for them, especially now with ChampEx joining the fold.
Right, we'll get to ChampEx. But what about digital and integration? This is where our stealth tech play idea might really start to take shape, yeah.
It certainly does.
Yeah.
Okay, so digital and integration saw revenue of $1 billion. Now, that was actually down 1% sequentially for the division overall.
Oh, okay. Why was that?
Primarily due to lower APS revenue in Canada related to that Palliser sale we just talked about. But, and this is key, the digital revenue itself was basically flat.
Interesting.
Yeah, because double-digit growth in platforms, applications, and digital ops, that largely offset lower exploration data sales. And the margins here expanded significantly, 240 basis points up to 32.8%.
Wow, okay. That's a big jump.
Huge jump. Clear win from digital adoption, efficiency gains. They mentioned over 800 users now on their Dell platform. That's double-digit year-on-year growth. But the biggest signal,
What's that?
starting Q3 2025, they're going to report their digital business as a separate segment.
Okay. That is a strong signal, really carving it out.
Exactly. It says a lot about where they see the future value.
Yeah.
And, potentially chasing those tech multiples down the line.
That segment separation is huge, like you said. What about the other divisions? Reservoir Performance.
Reservoir Performance revenue was $1.7 billion. That declined 1% sequentially, mostly due to a bit of a slowdown in evaluation and stimulation activity internationally. But it was partly offset by strong intervention work, and importantly, margins here also improved nicely, up 203 basis points to 18.6%. So again, optimizing even where activity is a bit softer.
Okay. And construction, that's usually a big revenue driver for them.
It is. Revenue there was $3 billion, essentially flat sequentially. Margins, though, they did decrease a bit, down 119 basis points to 18.6%. Primarily, they said, due to an unfavorable mix, technology and geography mix internationally.
Got it. And anything else division-wise?
Just briefly, carbon capture and storage, CCS, that continued its growth. They highlighted successful execution on several large projects that are involved across the whole chain, capture to storage, pointing to the Longship project in Norway as an example. Definitely a key area for the long term.
Okay, good overview. Now let's talk ChampEx. The acquisition just completed. You hinted this is a really key piece of their transformation. What's the thinking behind it?
Yeah, it's absolutely foundational, I think, to this evolving strategy. Strategically, ChampEx brings in crucial capabilities, specifically in production chemicals and natural lift.
Which are important
Because those are fast-growing segments, really vital for long-term asset performance. Think about aging infrastructure, more complex wells. This is where operators need help. And it moves SLB further into that more capital-light, OpEx-driven model we touched on.
Right, focusing on services and consumables for existing wells, not just drilling new ones.
Exactly. It enhances their portfolio through vertical integration, gives them a global manufacturing footprint, and some unique digital production technology, too. It's a really complementary fit.
So it's not just about adding revenue, it's about shifting the kind of revenue they get. It sounds like they're aiming for, a more integrated offering. Reservoir to surface, completion through decommissioning.
That's the goal. Greater innovation, more customer value, that fully integrated service offering. Right. And geographically, it expands their reach significantly. ChampEx was strong in the U.S. SLB leads internationally, puts them together.
Okay. And how does it work financially? When does it start showing up in the numbers?
Right, so they'll start consolidating ChampEx from August 1st, 2025. That means you'll see 2 months of ChampEx results included in the Q3 numbers.
And where will it sit? Within which division?
Most ChampEx activities will roll up under production systems, but their digital activities, those will fall under SLB's new standalone digital division we just discussed.
Oh, okay.
And one small note, ChampEx digital revenue will be aligned to SLB's definition, which they said will be lower than what ChampEx used to disclose. So just something to keep an eye on. Don't be surprised by that adjustment.
Got it. Good flag. Now, the $1 million question, or rather the $400 million question, Synergies. What's the target? How fast?
They're confident, they say, in generating a pretty substantial $400 million of annual pre-tax synergies. And that's within the first 3 years after closing.
Okay, $400 million annual. How does that break down? Cost versus revenue?
It's weighted towards cost. A hefty 75%, so $300 million, comes from cost synergies.
Yeah.
About half of that from supply chain savings. And that's across both ChampEx and SLB's existing cost base, which is interesting. The other half is from operating costs and G&A savings.
And the rest?
The remaining 25%, $100 million, is targeted from revenue synergies. They've identified those at the country and customer level already.
That's a significant chunk, especially the cost side. ChampEx, you mentioned their Q2 numbers.
Yeah, roughly $850 million in revenue for Q2 2025 and adjusted EBITDA around $190 million. So you combine that base with those synergies, it's expected to deliver pretty visible margin expansion for SLB overall, reinforces that margin resilience story.
And how quickly does this actually become accretive? Does it help the bottom line soon?
They expect to realize half of those total synergies within the first 18 months. That's pretty quick. And that pace makes the whole transaction accretive to both margins and earnings per share on a full year basis starting in 2026.
So adding to earnings next year already, that's key.
Definitely key. And just quickly on the mechanics, they estimate about $80 million incremental annual pre-tax amortization expense from intangible assets. That works out to roughly 4 cents of EPS after tax.
Okay, need to factor that in. And shares, they issued stock for this, right?
It did, issued 141 million shares of SLB stock. But, and this is impressive, since they announced the deal back in April 2024, they've already repurchased 78 million shares.
Wow.
Yeah, that covers 55% of the shares they issued for the deal. It's a strong signal of confidence and shows they're actively managing that shareholder dilution.
Absolutely. That definitely helps address dilution concerns head on. Okay, let's shift focus again. What about their guidance for the rest of the year, the second half of 2025? What's the top line look like?
Okay, H2 revenue, they're guiding to a range between $18.2 billion and $18.8 billion.
And what makes up that number?
Well, it accounts for ChampEx's 5-month contribution, obviously. Combined with what they see as steady legacy SLB business revenue compared to the first half, they expect growth in production systems and digital to basically fully offset anticipated activity declines in the U.S., particularly on land and in certain other product markets.
So kind of a mixed shift benefit there. Production systems and digital pulling harder. It sounds like H2 revenue might be a bit backloaded into Q4 then.
That's exactly the implication. And on the margin side, adjusted EBITDA margins are expected to be roughly flat compared to Q2.
Flat, even with ChampEx coming in.
Yeah, flat inclusive of ChampEx. And they specifically called out a 20 to 40 basis point negative impact from tariffs. So if you strip out those tariffs, margins would actually have expanded by 20 to 40 basis points.
Ah, okay. So underlying efficiency gains are still happening.
Absolutely. The core business is still improving its profitability. Breaking down H2 further, Q3 revenue is expected to be just slightly higher sequentially compared to Q2.
What are the moving parts there?
Well, you've got 2 months of ChampEx coming in, but you've also got the full quarter absence of Palliser revenue. Plus, those activity declines in the U.S. and some offshore areas. And they mentioned a specific pipeline disruption in Ecuador impacting Q3.
Okay, so a bit muted sequentially in Q3, then Q4.
Then Q4 revenue is expected to jump higher by high single digits versus Q3. That reflects getting a full quarter contribution from ChampEx, plus the usual seasonal uplift you see from year-end digital and product sales.
Got it. What about the broader market outlook? How are they seeing things?
Well, they acknowledged the oil and gas industry showed, significant strength and resilience in the first half. But the second half macro environment, it remains uncertain, particularly with OPEC plus potentially releasing more supply into what looks like a pretty well-supplied market right now.
But are those barrels being absorbed?
They noted that, so far, incremental barrels are being absorbed by pretty strong demand and also inventory replenishment, with global inventories still below the 5-year historical average. So their base case assumes sustained resilience, barring some dramatic collapse in commodity prices.
And regionally, where do they see strength or weakness?
Regionally, Middle East and Asia are expected to show the most short-term resilience, lower break-evens there, continued focus on energy security. Advantageous offshore projects should support steady markets in Europe, Africa, and the Americas too.
And the downside risk?
Land activity, particularly North America and Latin America, that has the greatest downside risk because its short cycle spend reacts much faster to any price dips or sentiment changes.
Makes sense. And what are operators actually doing right now? What's their focus? Still drilling like crazy?
Not necessarily drilling like crazy everywhere. Operators globally are expected to remain focused on critical in-flight development projects first and foremost. Accelerating efficiency gains is huge. A heavier focus on production recovery, which ties perfectly back to ChampEx, right?
Right.
And continued investment in digital and AI. Looking beyond 2025, they do see the attributes of a cycle rebound starting to emerge.
Driven by what?
Things like liquid market rebalancing, continued investment in Middle East oil capacity expansion, accelerating global gas supply projects, a pretty robust pipeline of offshore and deepwater projects, and that increased focus on production recovery combined with digital and AI. They really emphasize the market remains rich with projects internationally, especially complex ones needing advanced tech.
Okay, that sets the scene well. Now, during the Q&A session on the call, management usually offers some extra color. Anything interesting pop out? What about deepwater? There's been some chatter about a slowdown.
Yeah, they address that. They see the recent Namibia situation as more of a temporary appraisal-driven effect, not really indicative of a broad slowing in deepwater overall.
So where are they excited about deepwater?
They actually expressed more excitement about the Americas, specifically mentioning Suriname, Brazil, Guyana, Mexico, and also Eastern Hemisphere gas markets like Indonesia, Mozambique, and the East Med. They sound pretty confident in a directional rebound for deepwater overall by 2026. It's a longer-term positive view.
Okay. And their production business, now obviously bigger with ChampEx, that must have come up.
It did. They believe the ChampEx deal creates an unmatched portfolio, really focused on helping customers get more value out of the production recovery phase, especially from aging assets.
Which sounds like it makes them less sensitive to short-term oil price swings.
That's exactly the point. It includes integrated offerings beyond just, say, lift or chemistry. It leverages digital, well, services, intervention, surface equipment. It's a whole package. And crucially, this market segment optimizing existing production is actually expected to outpace global CapEx growth.
So it's a structurally growing, more resilient market.
Precisely. A very attractive place to have a stronger foothold.
And the digital business, you mentioned it's on track for mid to high teens growth this year, way ahead of the market. How's the actual adoption looking? Are customers using this stuff?
Yeah, and it's becoming increasingly accretive to their margins, too. They threw out some stats. Consumption of 40 million CPU hours, that's up 50% year on year, shows real computational intensity and uptake. And 1,000 wells have now been drilled using their drill plan application.
Okay.
And they also introduced something new, the Lumi platform. It's designed for data and AI adoption, basically offering customers a toolbox of AI capabilities to integrate and really leverage their own data. This is where that tech company identity really starts to, feel tangible.
Right. Accelerating the synergies from ChampEx was another theme, wasn't it? How are they doing that?
They confirmed they've done extensive planning over the last 12 months. They have a detailed playbook ready to roll out literally day one.
And that means?
It means faster execution, especially on those supply chain cost synergies, and allows them to capture revenue synergies more immediately. That's what underpins that accelerated accretion timeline we talked about, hitting accretion in 2026. They also noted a really positive reception from both the ChampEx team and customers, which is always crucial for smooth integration.
Definitely helps. One last regional point, Mexico. It's faced some challenges recently. What was SLB's take?
Yeah, they acknowledge Mexico has seen significant activity reductions because of restructuring there. But SLB stated they're ready to respond to future developments, whether it's gas or other things, working with Pemex and local independents. They even highlighted an exciting Woodside project, Port of Mexico, starting early next year. So while it's been tough, they definitely see some green shoots appearing.
Okay, interesting context. All right, now for our favorite part. This is not financial advice segment. Remember, everyone, this is purely for entertainment, maybe some food for thought. What's your outrageous but plausible trade idea this time?
Okay, here it is. Go long SLB. But, and here's the twist, view this specifically as a stealth technology play that just happens to be disguised as a traditional oil field services company.
Intriguing. Explain the thesis.
The thesis is this. Despite all the current macro uncertainties, the short-cycle land market headwinds we discussed, I believe the market is significantly underestimating the combined power of SLB's strategic pivot and its accelerated synergy capture from ChampEx. The ChampEx deal is not just about adding some production services revenue, it's about accelerating this shift to a more capital-light, OpEx-driven model focused on that complex, resilient production recovery market. But even more importantly, the explicit separation of the digital business, its continued double-digit growth, plus the launch of the new Lumi AI platform that screens intent to capture and realize pure-play tech multiples for that whole segment.
So the outrageous part is?
The outrageous part is betting that this fundamental re-rating of a significant chunk of SLB's business, driven hard by digital and AI, will actually eclipse the lingering commodity price worries or cyclical concerns, that it forces the market to reevaluate SLB's long-term growth and margin profile way beyond current expectations, effectively turning it into an overlooked growth stock hiding within a mature industry.
A stealth tech growth stock in OFS clothing. That is pretty provocative. Okay, let's wrap things up. Key takeaways from SLB's Q2.
Well, first, their diverse portfolio and broad footprint really helped them deliver solid results despite those global headwinds. That resilience stood out.
And the ChampEx deal is clearly pivotal, massively increasing their exposure to that growing, resilient production recovery market, enhancing their tech and digital leadership.
Exactly. And while the near-term market has uncertainties, global oil and gas showed resilience. And SLB sounds pretty optimistic about H2 growth, and especially their long-term opportunities. Those are really driven by these strategic shifts we've been talking about. Production optimization, digital transformation, and smart M&A like ChampEx.
A compelling picture. And as always, folks, remember, this deep dive is purely for informational purposes. It is absolutely not financial advice. Always, always do your own homework, conduct your own due diligence, and please consult with a qualified financial professional before making any investment decisions.
Absolutely. But we do encourage you to keep exploring these themes. What aspects of SLB's strategic pivot, as potential transformation, do you find most compelling? Or maybe, what parts do you think the market is still overlooking? We'd genuinely love to hear your thoughts.